So, this fireside chat will focus on how investors can strike the right balance between equities and debt in their asset allocation formula as they cross various milestones in life. Now, Bhavdeep Bhatt, head of retail sales at Aditya Birla Sun Life Mutual Fund, joins us for this segment. Bhavdeep, great to have you with us and looking forward to your insights. Now, we've just had a panel of leaders talking about millennials and wealth creation. So, I'm going to take a cue from that conversation and ask you, what are some of the investment terrains that, say, young investors can explore early on in their investment journeys?
Yeah, thanks, Gautam, for having me on this show. First of all, I think generally I have seen that the young people in India over the last few years, particularly 3 4 years, have really warmed up to the idea of savings and investment in general. Now it's pretty much about where to invest, rather whether to invest or not. So I think the concept of savings and investments is kind of embedded there. Now, the biggest asset in investment is not the capital itself, but the time that the people have on hand. Because we are talking about in the investment, the core to investing is the concept of power of compounding. We all know, and in power of compounding, we all know the exponential effect is of that n, the time in the market, rather than the capital that you have or even the rate of return out there. And young investors have a lot of it, and to that extent, they are much richer in that sense of the term. Now, what should they look at, or what are the investment talents they can kind of explore early on in their life? Is first of all the equity. Everyone understands that equity is a long-term growth vehicle for investors, and pretty much like for any young investor or young person. Gautam, they have made a fundamental choice at an early on in their career of whether to kind of go for service, or they want to go and join business, whether family business or otherwise. And they've made a fundamental choice of how the trade-offs of both these two options that they have. Essentially, if I were to broadly say, a service is pretty much like a fixed income kind of a path where there is a fixed return, there is some incremental return on that, but there is pretty much like a uh, uh, fixed return path, and then there is a business path which is extremely volatile, but it could be extremely rewarding over a period of time. Now, these are the two paths, and one has kind of understood innately of what are the pros and cons of both of this. And most of the people who don't have to join business to kind of explore the benefits of business, they can be into service and still start investing early in equities and really benefit from the power of the growth by investing in multiple businesses. I would say that pretty much out of this terrain of debt and equity, what would really suit young investors early on in their career is equities investing. And essentially, the two fundamental tenets of investing are start investing early and invest regularly. And if you do these two, the power of compounding does the rest of the things for in the wealth creation journey of an individual.
Absolutely. The power of compounding always works. But one of the points which was raised in the previous discussions was also that the young investors have a higher appetite of risk. And in fact, they view investing in equities as a relatively conservative approach, considering, they have a host of other investment opportunities that they're excited about, whether it's cryptocurrencies or
Yeah.
ESG or so on and so forth. So let's put that in the context of goals. For young investors who are prioritizing goals, especially, say, long term ones, that can be tricky given that they have more room to accommodate aspirational and materialistic aims because they may not have any major financial responsibilities. So, how can they ensure that long term goals, such as, say, retirement investing, do not get relegated to the backseat when they start their investment journeys?
In my experience, Gautam, I have found out that even the seasoned investors who have been in the capital market or an investing journey for 10, 20, 30 years don't necessarily have different buckets of investing for the different needs. Now, financial planning would suggest that one does that, but I have seldom seen in practice people do that. So, what I would really like to, maybe it's a factually correct, but socially inaccurate or ineffective way of, I think, advising young investors, in my view. If they have understood the power of compounding, if they have invested the value of equity early on in their career, I think that would be wonderful. And if they just get one concept right, that it is the saving, whether the residual, so one is earning some income. Now you first decide how much do you want to save and invest, or you decide how much to kind of consume or spend. If they get that priority right, that out of income, first decide how much you want to save or invest, and then remaining amount you kind of spend. If they get that priority right, that itself is going to be a big win. To ask a 25-year-old individual, girl or boy, to start investing for retirement saving, while it factually and over a period of time maybe it's the right thing to do, I would suggest that just get them going in terms of understanding equity, the business, how the power of compounding works. Get them to start SIP, let them stay through it, through volatile time periods. That itself is going to be a powerful induction of them into long-term wealth creation journey, is how I would see it. And over a period of time, yes, you kind of understand that in India we don't have social security available. The families are becoming nuclear, and because of the improving health situations, etc., people live much longer now than a few decades back. And therefore, of course, the post-retirement savings are important. But I wouldn't really worry for a 25-year-old to start investing in retirement. I would rather worry, or rather would kind of appeal to them to start invest regularly, and just stay through the market cycles, and that itself will kind of put them into a very strong footing in their later years of retirement planning.
All right, from 25-year-olds, let's look at 35 to 40-year-olds where they are ready to take out some big ticket loans. So, in that context, how should these kind of investors in that age group of 35 to 40 who are looking to take out those big loans, how should they tweak their asset allocation? And if they should, what are the things they should consider?
Yeah, so first of all, for asset allocation, I would rather like to look at the investment horizon rather than the age as the deciding factor for asset allocation. And let me just elaborate a bit on what I mean by this. So, for example, if let's take two extreme examples of a 25-year-old who wants to wants to plan his honeymoon or her honeymoon 2 years out, and one is saving for that. Now, I would, even if that person is young, I would not suggest that individual to put everything in equity necessarily for those 1.5 2 year sort of planning. And there is another individual who is 70-year old, and they want to, he or she wants to kind of put money for the grandchildren, and grandchildren's higher education maybe, or once they turn adult, and therefore the investment horizon is 20 years. And I would suggest 100% of that money goes into equity rather than going by their age. So the conventional method or wisdom suggests that it's 100 minus age, and that becomes equity, etc. But in my limited experience, what I've seen at work is time in the market essentially for any individual that really should be a deciding factor for how much should go into equities. Now, coming to your question, of for a 35 to 45-year-old individual, whether it's the right time to start retirement, or what should be the asset allocation for them, depends on their investment horizon. Meaning, if they're really planning for the retirement, of course, there has to be higher equities to start with, and and then as the retirement approaches, one has to start sort of reducing some bit of equity exposure. And let me give you one anecdotal fact, that many people in the US started the invest participating in capital market and equities in mid 90s, when 401k kind of got very popular. Essentially, it's a retirement planning tool there. And in 2008, people were invested fully into equities. 2007, 2008, we market, the world never had seen that kind of rally from 2003 to 8. And just imagine if someone were to retire in 2009 or 10, 50% of your wealth of life got kind of eroded in just 1 year's time. Now, so and therefore, as you go approach your retirement, ideally there has to be some sort of glide path. Plane doesn't land, I mean, right, it doesn't go at the same altitude and then kind of drops like helicopter. It has its own glide path. And similarly, if an individual with 35 to 45-year age band, as they are planning in retirement, of course, I think 50 to 25 years is a long horizon for equity. So one should invest in equity 100%. And as the years approach, maybe every 3 4 years, individual should reduce their equity exposure, rebalance the portfolio, and make it a little more stable. And as one approaches retirement, maybe I would say not more than 10 15% should be into equities for that investor.
All right, Bhavdi. As you mentioned, there is a sort of a glide path required, especially for older investors. In that context, Indians, especially the older generations, they've gravitated towards certain asset classes while shunning others. And in that context, I want to understand from you what are some of the notions and biases that investors need to be wary of when deciding their asset allocation strategies?
Yes, so I think older generation individuals typically have gravitated towards more conventional return, risk return propositions like say deposits, etc. And one has realized that it's a short way of not losing money, but the growth is really restricted there. I'm very happy to share that actually in the last few years, thanks to investor education programs and some of the regulatory interventions, a lot of work by the advisory community. I think what we have seen over the last 5 6 years particularly is that more and more invest savers are kind of transforming themselves into investors rather than really sticking to fixed return options. They have started allocating part of their investments into equities, and that is really visible from the SIP book that we have in the at the industry level. For about 6,000 odd crores book, just about 4.5 years, 5 years back. Currently, industry's SIP book is 12,000 crore. Now, it means that people are at the margin gravitating more, or rather moving away from only fixed income investments to more balanced approach by including equities into their portfolio. So that journey has begun. And as the global experience suggests that once the equity culture sets in a country and more individuals kind of start investing into equity, it's an irreversible trend. Then it just kind of catches on, and the people risk appetite at a group level. It's like in COVID, we talked about this mass immunity. It's pretty much like that. It's a culture, it's a cult. It's risk appetite sort of goes up, and that we have started seeing in India. And if once person has benefited or experienced the power of equities, typically part of their investment will always be into equity. So I think that culture is fast changing, and that's a very good news for all of us.
All right. Now that we've understood asset allocation from the perspective of young, middle aged, and older investors, let's dial back to understanding broadly about asset allocation strategies. So, Bhavdi, what are the different kinds of asset allocation strategies that that you could explain to the viewers? Could you throw some light on how investors can choose the right strategies based on their circumstances and needs?
Sure. So there are, broadly speaking, there are two types of asset allocation strategies. Bit technical words, but please bear with me on this. One is called as static asset allocation products, wherein very short window or a frame is decided. Like for example, balanced funds as a category. So where fund managers cannot invest less than 65% into equity and more than 80% into equity. This is called static asset allocation. Person invests in it, and one knows that generally 2/3 of the portfolio will be in equity, 1/3 portfolio will be in fixed income. This is static asset allocation, and where there is a particular payoff. Another category which has become very popular in India over the last few years in particular is dynamic asset allocation category, wherein fund manager bases the market trends decide how much investment should be into equity and how much investment should be into fixed income. First of all, asset allocation products will seldom outperform equity market in a short term. Simply because you are not invested 100% into equity, and your or broad market index would be 100% into equity. So to that extent, that comparison should not be carried by an investors for the purpose of return analysis. Having said that, this static asset allocation and dynamic asset allocation as product categories, my suggestion or again depends on the risk appetite of the investor. But for us investors who are just coming into the equity markets or are relatively into their formative years in terms of their capital market experience, I would suggest that go for dynamic asset allocation category, because it does two wonderful things. One is it does buy low and sell high. Essentially, in equity markets, the volatility is very high, and the investors' natural inclination is to kind of be very active in the market. Buy the market when it is low and sell the market or stocks when they are at a high price. But they seldom can do it. With the science and the discipline and the regulatory framework available in the mutual fund industry, fund managers are a lot more likely to be effective and successful at that. So I think dynamic asset allocation as a category is an outstanding tool for investors to benefit from the power of asset allocation without them really committing their bandwidth and time and resources to do that exercise on their own. So I would suggest, particularly the investors in formative years of their capital market journey, to kind of to invest in this category of funds. And I'm pretty sure that over a period of time, it is very, very likely that they will have a decent alpha or a higher return over FD with a much lower volatility. So I think it's a great combination in that sense.
All right, static and dynamic asset allocation strategies explained for you by Bhavdeep. Before we wrap up, Bhavdeep, do you think taking the hybrid fund route can be beneficial for those who say do not feel confident of being able to maintain the right asset allocation mix by themselves, or say those who have just started their investment journey? Your thoughts on this?
Yeah. Yes, Gautam. So dynamic asset allocation category is one which I believe could do that job for investors. And also there is another category which is coming up, which is called multi-asset category, multi-asset funds. Now, these multi-asset funds actually give you benefit of investing across multiple asset classes, not only equity and fixed income, but also in gold or commodities and real estate as well. So it's like a complete solution, or a wholesome package that investor can get. So these are the two categories I think which would be very useful for investors to look at and generate a very competitive return over conventional savings instruments, and at a much lower volatility than typically the which the equity market sort of brings to them. So yes, these are the two categories: dynamic asset allocation, or what we call is balanced advantage fund as a category, and multi-asset fund as a category.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.